Hi, everyone. Welcome back to the IT Investor Podcast, the show where tech professionals like you learn how to build real wealth through smart, passive investing.
I'm Wally, your co-host. Whether you're writing code or scaling cloud infrastructure, we're here to help you make your money work harder than you do. So Pramod, how are you doing? Anything new at work?
These days I'm working on an interesting project. Actually, my role kind of little bit transformed into a data scientist from data engineer.
Okay.
Yeah. So basically, long story short, I have a new requirement where I do need to build sentiment analysis. A little intro about it. Sentiment analysis, like Facebook and Twitter, there are many comments people enter, right? And you have to go through, parse those words and all that and see what is the general sentiment, whether it is positive, negative, or neutral, kind of that. You have to categorize every person's, output into one of those buckets and build analytical report on top of that. So that's what I have been doing these days.
That sounds
How about you?
pretty exciting. Did they happen to give you a pay raise for taking on the new position, or what's
No, they don't talk about those things, right?
Just some scope creep. Some scope creep then, huh? Yeah. That's funny.
Oh, but on the contrary, I wanted to know, how was your vacation and how was your Father's Day?
No, it was good. It was good. The wife and I and the kids spent a week in Oahu. She has some family back there, so we spent most of our time visiting with family. Had a couple good beach days and doing all that. Father's Day was cool. I want to make an announcement to all the fathers out there. I don't know if you can see that or not.
Oh, I can see. You got
see what that says?
You can lift it a little bit more up. Yeah, best dad ever. Coffee mug.
Yeah, it took me 9 years as a dad, but I finally got my the official best dad ever title. So I'm the GOAT now.
Oh, that's awesome. So your kids, you?
Yeah, that was one of the presents. And I'm a big coffee drinker, so they got me some
Wow. Nice. And it is very interesting that I also have something similar.
Oh, yeah?
Yeah. But this is, as you can see, it's a beer mug. Yeah.
I'm not the best dad ever then. Apparently, I share the title with you.
No. I mean, for kids, it's always that parents are everything to them, right?
Sure.
That is their world. And ours is, their world. That's how it goes, right?
Absolutely. I mean, one of the main reasons we do what we do, right, is creating that. You always hear those terms, generational wealth or building legacy. I mean, that's legacy, man. That's family. Yeah.
Exactly.
Yeah. Exactly. Well, congrats to you being the best dad ever. I thought I was the only one, so hopefully there's actually a bunch of listeners out there that are also the best dads and moms ever out there.
Likewise, all the best to you and congratulations to you.
Thanks, man.
And welcome back.
Yeah, thank you.
Yeah. So, Wally, today we are diving into a crucial topic, finding the right deals. Because let's be honest, in your returns, your cash flow, your tax benefits, they all depend on only one thing, right? I mean, buying it right. So how do you find the right deal?
Here's a quick story. A friend of ours jumped in on what looked like a can't miss deal. It had a flashy brochure, high projected returns. There was a charismatic sponsor, but he skipped some of those fundamentals, right? Checking closely on the location, real expenses, what was the exit plan? Like, he didn't take that deep dive into the pitch deck and some of the underlying financials. 6 months later, the deal is barely breaking even, and there's some pretty nervous investors on that deal now.
Oh, wow. Yeah. And that's exactly why we are doing this episode. Today, we are going to dive into one of the most crucial real estate investing, finding the right deals. Because let's face it, returns, the cash flow, tax benefits all start with how well you buy. If you overpay or miss details, no amount of asset management can save a bad deal. And in this episode, we will cover what makes a deal truly good, how to spot opportunities, and why smart buying is the foundation of long-term success.
Absolutely. So if you're investing passively or underwriting your own deals, this is one episode you don't want to miss. Grab a coffee, your notepad, or maybe just pop in those AirPods and let's get into it.
Okay, so what the right deal actually looks like, or what makes the deal right? It's not just about cap rates or market hype. I mean, we have to look at a few things. A strong market with job growth and population inflow, value-add opportunities where we could use force appreciation, solid in-place cash flow, and a clear exit strategy. And usually our exits are mostly on an average 5 to 7 years. And one of the biggest mistakes tech investors make is chasing shiny objects like Airbnb, pre-construction, exotic markets. And we all should remember one thing, we have to stick to fundamentals. Yeah,
absolutely. I mean, that's just such a commonality with us folks in tech. You know, we like we like the new shiny object. What's the new thing coming out? I want to try the new algorithm, or it goes the same though with investing. A lot of times just sticking to the fundamentals, the tried and true is oftentimes your best way to go. So let's get tactical. There's 5 ways you can find great real estate deals without quitting your job. Number 1, you can partner with an operator, investing passively with syndicators who specialize in finding and operating those deals for you. Another great way is just to join investor communities, local meetup groups, online focus groups, and whatever asset class you're into. A really good place to start. I know Arizona has one. I'm sure they're all over the place. They're real estate investor meetups. I'm trying to think of the one here that I'm involved in. There's a gentleman here in Phoenix, the name of Pace Morby. He's a big creative finance guy. You may have heard of him.
Yeah.
He has meetups here in town. But yeah, just find your tribe and build those relationships. Speaking of relationships, broker relationships. If you're looking to buy yourself, it's good to build connections with brokers who know your specific criteria, ours being multifamily. You can leverage tools and technology. There's websites out there, PropStream, ListSource, to find property and owner info. And using those tools, you can pull down list of properties, and that may be something that you use to reach out to owners directly by doing mailings or cold calling. Number 5, off-market strategies. Partner with wholesalers or direct mail marketers who find those motivated sellers for you. Pramod, I know you've had some experience in some of this. Can you elaborate on sending out mail campaigns?
Yes, I can definitely talk about this. So basically, there are 2 most underrated campaigns. One is the direct mail campaign, and the other one is the cold calling. I personally have done direct mail campaigning, and I know how time consuming and how hard it is. Yeah. So I actually used all of my family's help with this. I got the most help, I think, from my younger son. He actually was folding all the mails while watching the YouTube video. And I was watching, of course, enjoying the YouTube videos along with him. Sure. But let's get into the basics. I mean, how we do this is, it's a 2-step process, Wally. First is you need to build your list. And how you can build your list is there are some online data platforms like, as you mentioned, like the PropStream or the ListSource. You just take some subscription and you download the list of all the owners or the contact list, for all those multifamily property. And let's not forget also, you could go to the county property records where you can get this freely. And again, you do need to filter out based on your criteria. Say, for example, the property size. Example, if you're looking for any multifamily with 5 to 50 units, so you apply that filter. You can apply more complicated filters like out-of-state owners or long-time owners, 10 plus years, or any code violations or any non-tax payments, where the property owners or the multifamily is really distressed, right? And using all that criteria, you can build your list. Now, once after you build your list, all you do is you write a 1-page letter to whom you are mailing. And this can be a simple letter, not complex. You can say, I'm a local investor interested in buying rental properties in your area. And if you're thinking about selling, just want to explore options, I would like to talk to you, and no pressure. As simple as that. And you print out that and get help from a family or anybody. Put the stamps and envelopes and head out to the post office and mail it. So what I've generally seen is the hit ratio is about 2 to 3%. It's not that much, actually. For some reason, I did not get good success with it. And probably you need to have more patience, I think, for this type of campaign.
Yeah.
Yeah.
I cut you off. I'm sorry. Yeah.
Oh, yeah. So it is time consuming. Again, a little bit tedious. The success rate is 2 to 3%, but not that to discourage, viewers. Many people have used this strategy and are successful or were successful. Yeah.
I would say being consistent, probably important too. Like, someone's not going to sell you their property off of one mailer. It might take 2 or 3 to get through to somebody. There was one little nugget there that I caught that you shared was your criteria. You mentioned those out-of-state owners or those long-time owners or code violations or past due taxes. Yeah. Those are actually really great signs of somebody who may either maybe neglecting a property or just maybe they're burnt out or tired of being an owner and they're looking for that opportunity to sell something. So those are great things to filter on. A good tip there, Pramod.
Yeah, exactly.
Let's talk a little bit about the cold calling owners. Now, I know that does sound kind of scary to some of us, right? Picking up a phone and just talking to a stranger, but this is where you can get deals done really fast. And here's how to make it work. Even if you are an introvert, You can skip trace owners. There are services out there. You can batch skip trace and get a list of phone numbers similar to how you found the addresses for property owners. Services out there called like batch leads or prop stream. Same idea, right? Provide that same criteria, and then use a script, but try to sound human. It doesn't have to be super complicated. Something like, "Hi, my name is Wally. I'm a local investor, and I'm calling to see if you're ever considered selling your property at the address." And then let them talk. Don't try to sell. Just kind of be curious. If you do come across a motivated seller, plenty of reasons why that might be the case. Divorce, medical bills. We mentioned out-of-state owners, tax delinquencies, things of that nature. Just try to be human. Try to listen and understand what their problem is. Be helpful. Kind of that simple shift from trying to get the deal to helping them solve a problem is a great way to build trust. And that's where you will probably find sellers who will say yes. The bottom line, motivated sellers are out there. They're not always waving a sign like, "Hey, I'm ready to sell my property." But if you know how to listen and how to help and act with integrity, you will find deals that maybe others won't necessarily come across. There is also, if you don't want to spend a ton of time doing those phone calls yourself, there's actually a really cool service I came across recently called prop.ai. We're not sponsored by them. We're not trying to sell the service. It's not cheap. It's $249 a month, but it will do those automated calling for you. And it's an AI that you provide your list of phone numbers you want to call, and it will do kind of that first call, that first reach out for you. Maybe set those appointments with owners that might be interested, and then you can pick it up from there and actually talk to a warm lead. You're not worth $249 a month every month for 12 months, but hey, you know what? If you have a list of 5,000 properties, like hit it with that 1 month and see what you get back for a month, and then kind of take it from there.
Yeah.
It could be a good option if you don't want to cold call yourself.
Yeah. I think I actually like this service, prop.ai. I would say it's, the price is good. Otherwise you would be spending a lot of time, right? Let's be real. How many calls can you make a day? Maybe 100 or 200, right? But with AI, you can make 1,000 calls a day.
Sure.
And create those first appointments. So, Wally, I think based upon these two strategies, the direct mail and the cold calling, I think you can be more successful if you use the combination of both, meaning you send a direct mail and also do a cold calling after a few days and follow up as a second or a third touch point. People just do not say yes on your first call. And that's the reason why we might need to have multiple touch points for these owners. Yeah. And I like what you have mentioned that you have to, gain their trust, and you need to work with integrity. And sometimes you can, or most of the times, there are hidden gems out there, and you can get owner financing. You would not need a bank, which is a big win, right?
Yes.
In finding these deals. Yeah. Okay, so let's see. Next, I think let's look into underwriting. Once after we find the deals, how do you underwrite the deals, and what makes the deal right? Let's get into that, Wally.
Yeah, absolutely. Just kind of thinking about that topic. One of the biggest traps that new investors kind of fall into is getting emotionally attached to a deal. They might find multifamily complex. It's in a cute neighborhood, or reminds them of the first place that maybe they grew up in as a kid. But really, none of that matters if the underwriting, it doesn't work. Exactly.
In tech, we pride ourselves on making decisions using data. We look at KPIs, the system performance, the error rates, the graphs. No feelings, right? Real estate should also be the same.
Absolutely, Pramod. Yeah, absolutely. So let's talk a little bit about where these deals are hiding. If you've been browsing online listings, it probably feels like a good deal is already taken overpriced. We've all seen LoopNet. We've heard that it's called the graveyard of deals for a reason. Most of those deals have been sitting there for way too long, sometimes over a year. But here's a secret. Those great deals, they don't sit on the shelf. They're discovered, really. They're not displayed on LoopNet. I think LoopNet is a great place to find those brokers and start a conversation, maybe even, engage on one of those these dead deals, and then explain to a broker why it doesn't fit your criteria. And then you almost flex a little bit of your expertise. You're not just a random noob trying to take their time when they're looking for motivated buyers. But yeah, most solid deals are off market. Doesn't mean they're secret or shady. It just means they're shared directly through that relationship with a broker or a sponsor. A lot of sponsors often get those deals from brokers or owners that they've been partners with for a long time, and they'll find those deals long before they go public. Another place deals hide is in markets people aren't necessarily paying attention to, right? I mean, there's markets right now that are very hot. The Carolinas, Texas, some markets down south. People are talking about Phoenix, Austin. What about places like Tulsa or Columbus or Fayetteville? Those don't necessarily make those headlines, but they have good cash flow. And smart and savvy investors, they know where to look, right? Look for areas with job and population growth, landlord-friendly laws, undersupplied rental markets. That's a big one. And then the cap rate compression opportunities.
Yeah. So, Wally, have you heard great deals aren't found, they're created?
Yeah, yep. True words have never been spoken. Yeah, definitely.
Yeah. A lot of new investors think that deals are just out there waiting to be picked up. But in reality, best deals are actually manufactured through value add strategies by raising below market rents or reducing operating expenses or adding laundry or a storage room or rebranding or repositioning the property. Now, when you partner with a sponsor who specializes in these strategies, you are not just investing in real estate, you are investing in their ability to create value.
Yeah, that's the big thing, that creating the value, that the forcing appreciation. Also, if you want to know where the real opportunities are, follow what experienced sponsors are doing, not what they're posting on social media. The ones quietly buying right now are finding gems while everyone else is a bit frozen. They could be buying some distressed properties. Distress doesn't mean foreclosures or flames. It just means that there's a tired landlord out there, or maybe a partner that needs to exit. Or it could be a property that's a good property, but just has some deferred maintenance, or it's been under a poor property management company. After the purchase, that's our chance to send an experienced team that comes in to take it over, improve operations, and create that upside. And that's where passive investors can win without having to do that hard work themselves.
Yeah, that's exactly right, Wally. I mean, to summarize where the deals are hiding: in off-market channels, in overlooked cities, in good underwriting, in distressed but fixable situations, and most importantly, in the hands of great operators.
Yeah, the operator is the big one there. I mean, as a passive investor, your job isn't to be the one chasing the deals. It's to find the people who you want to work with that are quietly finding and creating them for you.
Correct. And these operators, they know how to bring value, right? I mean, they know how to fix the property, how to make the best use of the capital and budget for bigger ROIs.
Yeah. Okay, Pramod, let's take a quick look at what some of the red flags that most investors might miss in a good deal that are truly deal killers to watch out for. Number one for me, overly aggressive assumptions. If a deal is projecting 25% IRR and a 2.5x equity multiplier, you have to ask yourself, like, how is that sponsorship team really getting there? Those are pretty lofty goals. Are they projecting a 6% annual increase on the rent when the market average is 2 to 3? I mean, right now, a lot of good markets, rents are pretty stable. We're not seeing, these huge rent increases. They're sitting at, 1% or less.
Mm-hmm.
Are they assuming that they're going to renovate 100% of the units in the first 12 months? That's not easy to do if you have people living in a unit.
Yeah,
Plus,
you have to wait until they leave the place, right?
Yeah. And so you're not buying a property that's 0% occupancy, right? I mean, if you're buying a good deal, they're gonna be 80% plus occupied, hopefully more than that.
And actually, just to add a little bit, Wally, banks do finance multifamily properties if the occupancy is greater or equal to 95%.
Is that what it is?
Yeah.
Yeah. So there you go. You're renovating maybe 5% of your property a year. Yeah. I mean, and it's also hard to always kind of plan those. If, tenant moves out, you have to make sure your labor is ready to go. And if there's permits or anything else that needs to be done, or supplies ready, that needs to all be kind of timed really well to make all those happen. So
Yes.
definitely not easy to get all of your units done in a year.
Yeah.
Another red flag, right, is underestimating expenses. We've seen deals where taxes are projected at a current rate, right? But when we buy it, the rates go up.
Yeah.
That's
I mean, on the county side, it triggers like if there is any new purchase.
Mm-hmm.
And the county always tries to get more tax dollars, right?
Absolutely. Yep. Yeah. And so if you're not projecting that increase, that's poor underwriting. It's not being very conservative. Insurance is another one too. I mean, if you're underwriting using whatever the current insurance rate is from the the current owner, like you can assume that your new insurance is going to cost you a lot more, maybe double. So being very conservative with those.
Yeah. And I just wanted to mention that when I was buying my properties,
Mhm.
I didn't know that tax would increase after I purchased, and I learned it the hard way.
Yeah.
After a couple of years, they came with the increase. I mean, in Virginia, it was a couple of years, whereas in Pennsylvania, the very
Mhm.
next year, they came
Wow. Yeah.
after me.
Do you remember what the increase was? Was it a pretty big?
Yes, it was about a 10% increase.
Okay.
Yeah, but you can always fight for that increase, you know. Some states do, or most states, I think. So I had to go through a attorney, like a real estate lawyer. The good thing with these lawyers is they fight with the county or state on our behalf, and if they lower the tax, only then they will charge us.
Oh, nice. Yeah.
Yeah.
So winner don't get paid.
Yes, correct.
Yeah. That's awesome. Yeah, and another red flag on the underwriting, you know, if your sponsor has, you know, penciled in repairs and maintenance on a unit at 200 per unit for a building that's built in the 1980s, that's probably not very likely. I would think a rule of thumb for something that's 40 years old or older is probably going to be closer to $300 or $400 a year in maintenance. You know, paying close attention to the underwriting by the sponsorship group. That's an important thing to take a look at. Another red flag is weak exit strategies. Are the sponsorship teams assuming that cap rates will go down in the next 5 years? That's really risky. I mean, conservative underwriting usually builds into a higher cap. You also want to ask what happens if the market isn't great in 5 years. Is there some contingency plan to maybe refinance and hold the property for longer?
Yeah, so Wally, I think it's because of this reason we see most experienced operators telling their investors the whole time is between 5 to 7 years.
Mhm.
So they are timing the market. So let's say if the fifth year, if the market is bad, maybe they would be selling or exiting from that property on the sixth or the seventh year.
Sure. Yeah. You got to set that expectation, right? Yeah.
Yes.
That's another red flag too, is if you see the exit strategy being marketed as, you know, 1 to 3 years or something that doesn't seem very reasonable, that's probably a red flag that either you've got maybe an inexperienced operator that's their goals are a little too lofty, or they haven't necessarily thought further into the future. Because you're absolutely right. I mean, with current market conditions, exits in 5 to 7 years is probably more typical than 3 years or less. Red flag number 4, that sponsor track record and their transparency. A lot of passive investors look at the deal, but they don't always vet the operator.
Yeah. You know, I mean, for these sponsors, you need to ask them directly the questions, you know, have they done this before? Meaning, have they done this value add? How much experience do they have? Have they done one cycle? Meaning, after purchase of the property, did they exit out also? That's another thing. You should also ask, how did their past deals perform? Ask them, or you should also try to figure out if they are transparent with communication and financials. Ask them if they send monthly or quarterly reports. Are they upfront about any challenges?
Yeah, upfront about challenges is a big one, right? I mean, there are a lot of operators out there right now that they've just entered this asset class within the last, you know, 3 years, 5 years or so. 2021 was pretty easy to do multifamily. 23, 24, 25, it's been a bit more difficult. And you mentioned going full cycle on it, right? Like when you're speaking with a sponsor or a GP group, have they actually completed and executed a business plan and sold a property and taken care of investors and gone to the next one? Another one you mentioned there too that kind of caught my attention is the communication style. Some accredited investors, they just, you know, especially if they've got a sponsor that they're comfortable working with, they're good with writing that check and just waiting on dividends to roll in. But if you're new to investing, it's good to figure out, you know, is that sponsor sending those monthly updates, and what does that like? Does it match what you expect from a sponsor? Because the last thing you want is to go and write that check for $50K or $100K, and then you're not getting the communication that you expect. So make sure you've matched up nicely. Let's see, red flag number 5, lack of reserves or plan B. Every deal should have operating reserves and CapEx reserves. You know, if there's no buffers, you know, minor issue becomes a major problem. And that's when that sponsorship team is making that second phone call back to the investors, what they call a capital call. That's taboo. Nobody wants that in this industry. The GP team doesn't like making that phone call, and the investor doesn't like to have a call that says, hey, we need more money to make this deal work.
Yeah, exactly. And some other questions could be what happens if in that property, if it is taking longer to lease up or if the interest rates are spiking up again.
Yeah. Yeah, those are good points, Pramod. A smart operator will plan for those speed bumps. If a deal is tied on cash from day one, that's definitely going to be a red flag for me. I think red flag number 6 is that too good to be true marketing. If a deal looks like a Silicon Valley pitch deck but lacks real data behind it, that's a signal. I mean, how in depth does that pitch go? Is it breaking down the fundamentals for you? Are you able to take a deep dive with the capital raiser and the investor relations folks if you needed and wanted to? Is it out there? If there's a lack of that real data behind it, that's a signal. You need to be able to trust the numbers and not just the design.
Yeah, exactly. So now let's look at the deal funnel, Wally, if you may. How many deals do you need to review to find a really good one deal? I can talk personally about myself. I mean, usually I analyze about 100 deals. Of those 100 deals, I underwrite 20. Make 5 offers and maybe close on 1 or 2. Actually, 1. You pick the best one, right?
Sure. And that's a lot of work. And by the way, for those of you that want to get hands-on with the numbers, we will attach a Google Sheet to use to analyze deals. It's simple, structured, and built with passive investors in mind. Pramod will make sure that we can put those in the show notes for our listeners.
Yeah, sure. Absolutely. All right, folks, that's a wrap on today's episode, Finding the Right Deals. If there is one thing we want you to remember is great real estate investments are just found. They are created. And you don't need to quit your tech job to be in the game. You just need the right strategy and the right team.
Yeah, exactly. Whether you're sending out mailers, cold calling owners, vetting operators, the approach is like a data-driven project. The same way you debug code or optimize a data pipeline, you can underwrite a deal. Remember, the numbers don't lie, but your emotions do.
And remember, wealth isn't built overnight, but it is built step by step. Deal by deal. So whether you are debugging code or analyzing cap rates, just know you are not alone in this journey.
Okay, we'll see you next time on the IT Investor Podcast, where we turn code into cash flow and 9 to 5s into financial freedom.
Thank you.